Hello, good morning, tēnā tātou katoa, nau mai, haere mai. Welcome to Day 3 of the Financial Services Council 2020 Conference, Generations. I will be your MC and friendly face throughout today's program. I'm Yvonne Davey, Manager, Super and Savings, Craig's Investment Partners. And having been MC for last year's FSC conference, I'm delighted to be once again be part of this superb event in its new digital format. I hope you have grabbed your cup of coffee, tea, chai latte, or whatever is your regular morning beverage, and are ready to settle in for your session of choice. This conference has always been made by the sector, for the sector, with a big focus on providing gripping content to bring you the latest news, views and commentary from a broad range of speakers. Over the past 2 days, our breakfast sessions have targeted particular communities within the industry, including trustees and supervisors, workplace savings and Laduka. Today, the 3 sessions cover slightly broader topic areas with a medley of insurance, generations and FinTech sessions. If you have any questions whatsoever about the event, please get in touch by emailing us at events@fsc.org.nz. Enjoy the show and I look forward to seeing you later.
Good morning, everybody, and thanks for joining us. What a great intro and welcome. And here we are on the last day of the 2020 FSC Generations Conference. We are very kindly hosted this morning by George Carter, Managing Director of Nikko Asset Management. Now we're in level 1. Obviously, everybody's quite comfortable to be around the table together, which is great to be here. Guardianship, well-being and sustainability will be some of the things that we will talk about today, but there's a lot to discuss when we consider wealth and wealth tech generationally and actually what that may look like. Before we do get kicked off into our session, and our session is, we've called it, FinTech, Sweeping Changes, the role of tech in shaping the wealth of the next generation of investors. And there's some really key and interesting words within that as well. Before we kick off, we'll do some housekeeping. So those of us in the virtual world, be mindful where your virtual toilets are. We don't want any accidents that we have to take care of. But clearly, if you're at home or if you're in your own office, then if you don't know where they are, then there's also the problem. It is the 15th today, and some of you would have seen the advert on television. So it's in an emergency, you've got to follow protocol. And if you do have to evacuate the virtual world, that's pretty easy. You just click leave session. But easily, if you're in a building, then please follow the procedures that are laid out in front of you. But hopefully we won't have anything today, and there won't be too many dramas unless Barry and Stephen and George and Rachel start getting into some debate about who sees the world ever so slightly differently. But we're talking about wealth tech. I suppose my question really, and some may have it in the audience, what is wealth tech? And let's be clear. So we've sort of come up with, it's a combination of wealth and technology. It took us all night to really be very clear on what that actually was. But just for the audience participation, we thought that would be the case. And it's definitely very much under the sort of the umbrella of the FinTech arm. And like all things FinTech, it's under obviously some considerable challenges, but equally actually huge opportunity, not just because of COVID, but just because of the pace of change within the sector itself. So wealth tech is primarily about creating tools for the management of wealth and investments for investors. So today we have 4 industry experts laid out in front of you, looking very cheery, I'm sure you will agree. And what I'd like to do now is give them the opportunity to introduce themselves before we kick off into the main session. So if I can start from what you can see, I'd like to introduce you to Rachel Strevens. Rachel, can you just give us a little bit about you and your business, and I suppose, what you're looking to get out of the session today.
Sure, James, thanks. So hi everyone, I'm Rachel Strevens, founder and CEO of Invsta. So I guess my background is really from, wealth and investment markets. I was an AFA and worked for 10 years or so as a private wealth advisor across a number of different companies here. But while in those roles, I grew really quite frustrated with a few different things, really long, lengthy application forms that customers had to go through, a whole lot of compliance difficulties, and sort of just difficult processes around that really made it difficult and kind of turned customers off the process of going through it and making an investment. And those frustrations were really sort of the starting point for me of my journey with my FinTech startup in terms of, well, how can we actually use technology to make some of these processes a whole lot nicer and easier for customers and also from the company point of view. So that was the starting point for Invsta with us. We're a B2B FinTech company that provides a range of white label modules and interface solutions for wealth advisors, fund managers, and KiwiSaver providers. And all of our solutions are really focused around three core areas, being firstly to provide a really nice online client experience and associated engagement, to improve back office efficiencies, and then thirdly, to really look at streamlining some of those compliance processes. So I think this is a great sort of opportunity here, just have a general chat about sort of what the future holds. We've obviously been through a whole lot this year and a whole lot of learning, I think. So it'll be just interesting to see where people's views are on sort of wealth and how that will play into generating wealth in the future.
Barry, over to you.
Kia ora, ngā mihi nui kia koutou. I'm Barry Coates. I'm the head of a new organisation called Mindful Money. It's a relatively new charity. We started in order to provide the public, in particular retail investors, with information about investing responsibly, investing ethically, and to help educate and raise their awareness. And one of the issues that really drove us is we saw practices within the sector, such as management of environment, social governance issues, ESG issues, as part of risk management. But we often saw the public being confused about what was meant by ethical and responsible investing. There's obviously, from the annual surveys we do, a strong willingness and an interest in investing ethically. But there are barriers to them doing so. And so one of the things we wanted to do is to essentially bridge that gap between the desire to invest ethically and the practices which tend to have different strategies, different terminologies, and often end up mismatching with consumers. So that's the idea. It came to me a long time ago. I started on this journey in the early days. I have a master's in finance from Yale University, but worked for many years in sustainability. And so it's been really good to come back into finance and say, what can we do in finance practices, in wealth tech, in order to make finance a force for good in the world? And that's very much what drives me and drives Mindful Money.
Kia ora e te whānau. My name is Stephen Upton. I'm the Chief Operating Officer of Kernel Wealth. I guess in short, my journey is I spent about 10 years in private wealth management in Switzerland, working for the big Swiss banks, and then returned to New Zealand for family reasons after finishing an MBA at the University of Cambridge. And what I noticed is that in New Zealand, we didn't have the options available in Europe. I'd become very familiar with index fund management as part of personal wealth management overseas, and saw that we just weren't getting the products. So I initially worked for NZX and SmartShares here in New Zealand, and then decided to go out and co-found and become the Chief Operating Officer of Kernel, where we are bringing index fund management to New Zealand in a way that hasn't been seen before, and be able to provide access to the markets and to growing people's wealth based on my knowledge and Dean, my co-founder's knowledge of what can be done better here. So by combining the platform and the products, by being an MIS manager ourselves, we're able to deliver what we think is, in the index world, a much better product for New Zealanders.
Good morning, everyone. My name is George Carter. I'm the Managing Director at Nikko Asset Management. And my background in the financial services industry started back in 2000 as a consulting actuary in the UK, where I was the advisor to a number of corporate DB and DC pension schemes. So I've looked at the liability side of balance sheets, and then moving to New Zealand, got involved on the asset side of the balance sheet, so the other side of the coin. So I've been here in New Zealand since 2007. And my interest in this area is really around how do we ensure that investors get the information that they need to make good decisions. It's a very complex area in a number of ways, but in a number of other areas as well, we can find that there's simple ways of meeting people's needs. It's just making people feel comfortable and confident in the decisions that they're making around finances. And so I'm really interested in learning today a little bit more around some of the technology and the innovations and the development that are going to make people's investing journeys a little bit more helpful for them.
Thank you, everybody. What a great introduction. Lots of experience across various parts of the wealth sector. We've all seen that COVID has, to some extent, I suppose, really brought some of these conversations forward. And we've been forced, I suppose, into what I'd call a little bit going from the analog world to the digital world, where forced lockdown. And how do we have some of those quite interesting conversations where you would be having it face-to-face with an advisor, where you then take that into the virtual context as we are now for most. And actually, there's the elements of trust. You know, if I can't see you, touch and feel you, actually and eyeball you, and sometimes that's actually quite a cultural thing as well, then actually how do we know we're getting the right level of service, the right level of engagement, and even to your point, Barry, we were talking about there, ethical. So if I come in, if I open the segment a little bit around digital and AI, and there's been a lot of discussion over the years with AI and the future, and the robots are coming to get us, and Schwarzenegger and all sorts of stuff. And I wouldn't say that that's nonsense, because I think it has a role as part of the discussion. But I see sort of the technology as the enabler, as opposed to eradicating the need for certain parts of the wealth tech conversation. So I suppose if I can just throw it out there, maybe Stephen, actually, I'll come to you first. But what do you see in terms of the changing business model in the digital and the AI world? Where do you see it, where it was, if you may, and where do you see it going to in the future? Or now and then the future?
Sure. Look, the simplest way I describe it is AI as a toddler. So at the moment, it can do a few things. It can be helpful. It can pick up after itself a little bit. It creates a lot of mess a lot of the time, but it can be useful. But obviously, as it grows, and as we school it as well, and that's an important aspect around the ethics around artificial intelligence, that it will be more useful. The challenge around it is it's all about the training data. So if you're not able to educate in the right way, if you're not able to put the right inputs in, if you're not collecting from your customers something that's going to be useful, it becomes very much a so what argument. So I'm still a firm believer, because of that word trust, in the handhold and the hybrid models being the best solution. So yes, it will help advisors. Yes, it may support people in getting to a better decision and educating themselves, but it's not likely to be something that can depend on itself for a long time. Well, it will get there. It's kind of like chatbots. It's like, they work, but do they really, I think
it's a great analogy of the toddler. Actually, I hadn't thought about that initially, but I've made that very clear in my mind. George, if I can come to you then, off-the-shelf products or bespoke products in the sort of the digital AI world, so being able to blend both of them, do you see that that's more where your customers are actually heading, and where you would like to see that real in-depth type of conversation taking place?
There's so many ways we could take this line of thinking. I think the toddler analogy is helpful because there's a limit to what toddlers can do. But but also at the same time, there's an awful lot that they can do. And I think one of the interesting areas as this develops is that we can meet a lot of the needs for investors with some pretty basic technology. And I don't think we should lose sight of the fact that just because we can't solve every problem, do everything intricately, doesn't mean there aren't some really good tools that you can use there. And I've used the analogy before of clothes shopping. You can go and buy a tailored bespoke suit and spend several $1000s on it, but you might find that a $200 off the peg suit is doing a perfectly good job for you and for what you need. And there's nothing wrong with that. We don't need to get snobbish about that. And I think it's the same way with the use of technology. For a lot of people getting involved for the first time in the market, they're starting to save for a home or something through KiwiSaver. There's some really good solutions out there, and we don't need to overcomplicate it. And the technology can help do that in a way that before perhaps there were some limitations, either through cost, because just being in front of an advisor and all their experience and skills and everything else, that costs. And if you're starting off relatively small, you can't afford that service. That's okay. You probably don't need that at that point, but you might do later. So I think there's a way that the two integrate extremely harmoniously.
And I think that actually brings me to the question, Rachel, for yourself, if I may, that I definitely see this almost a little bit being like a tiered approach. You know, you can get some basic information relatively easily on your own, but actually when things become a little bit more complicated, then actually the blend of the technology and the advisor role, I think, for me at least, I foresee that for being the future. I don't see one, being without the other. But in terms of platform and some of the things that you're doing in your organisation, and years ago we talked about robo-advice and online advice, and there was lots of terminology. To the same question, I mean, what's your views on how that sort of sits in where you're obviously trying to take your own organisation?
Yeah, sure. So I guess I would agree with you absolutely there. I don't think that technology is going to come out all of a sudden anytime soon and replace the use of advisor. I think they very much go hand in hand. And I think, when we sort of started talking about robo-advice and digital advice quite some time ago, there was this big kind of fear that, that robo-advice would come out and replace sort of the advisor role. But look, I don't see that happening at all. I think what we need to understand is that there are tools out there that can help an advisor's role as well. And there are tools, it's kind of on a spectrum, right? So there are people out there, and there's new generations of investors coming through that want to engage digitally. They don't have their funds to be able to go out and pay for advice from a traditional advisor. They're looking to engage digitally. So we can put tools into their hands in a digital world that are really going to help them and benefit them along that journey. At some stage, they may actually want and may value from going and talking to an advisor and developing a relationship and getting some more complex help and sort of hand-holding and value add through that process. But I don't think it's a matter of sort of the tools are going to go out and replace advisors. I think there's some really great tools that advisors actually should be embracing to help them do their jobs. Some of that sort of more administrative work component of their jobs more, which actually frees up a lot more of the advisor's time to really add value in terms of what they're providing through to their customers.
Yeah, just on that, Rachel. So we've launched this tool, GoalsGetter, which some of you might be familiar with. It was primarily designed with a retail consumer in mind, and yet what we're finding is that the biggest users of the tool are in fact advisors for a particular segment of their client base, where a digital tool is so complementary to what they're trying to do for a chunk of their client base. And the take-up's been quite remarkable by advisors.
Yeah.
Just I want to keep to that point just for a moment, but Barry, just on the ethical side of things, you mentioned obviously mindful money and obviously what you've set up to do and what you want to achieve. But do you see any challenges in this, from the sort of technology adoption to the ethical play?
So it's interesting, as George says, the mindful money tool basically is a tool for transparency. We're able to show people what's in portfolios for all of the KiwiSaver funds and all the investment funds. And again, we thought it would primarily be for consumers. We're surprised by how many advisors don't have that information, and partly because we break down the information not only about direct investments, but also the indirect investments that are in funds or ETFs. So you get a full portfolio view that is not always available to advisors, so they can go onto Mindful Money and see that. And it's a kind of, it's an application of tech. This whole kind of world of ESG and ethical investing, which is new and still very much in its toddler phase, because we know a lot about fees and returns and the financial metrics. But if we're now saying there's a third dimension here alongside kind of returns and risk, so those are the traditional two dimensions, there's now an impact dimension. What's the impact of this investment on people and the planet? Now that third dimension is something that we don't have FinTech tools for. And I think for a lot of, when we're discussing the passing over of wealth between generations, this is a vital information not only to younger people, but many older people as well, as our surveys show. So it's a huge new challenge in terms of designing FinTech, and also through the use of AI, to be able to help people with this information. What we find is that if AI is illuminating as opposed to hiding, then it will develop much more trust. And the example that we have is when we're able to show portfolio information, we don't kind of use a fancy algorithm, we show people what funds invest in. And it's that use of FinTech to illuminate that actually builds trust, because people for the first time can see what they're investing in, and that becomes a trust point.
And I want to just hold that for a minute. I've often found it very interesting that from a single person's individual financial portfolio, that we've not for some time historically been able to actually see all of it in one place, and not necessarily for today's discussion, but the ability to manipulate the system to put people into further debt. You can quite easily forge I need another credit card, and some of this stuff actually is not apparent. If we move into the sort of let's call it the open banking and the digital identity space, all of that will be available, and I think that will be really good from an ethical point of view, because the business will be able to see what that person's financial situation actually is, and it could make some very interesting conversations. But I want to stick with that, because sometimes we do talk a little bit around age when we talk about people that are digitally savvy or more connected or more aware. But Stephen, I know as an example that I think some of your customer base actually are just a couple of years older than myself. So I find it very interesting.
Quite a bit older sometimes, James.
Yeah, no, it's okay. The Grecian 2000 is still working. But the other thing is as well, we've also seen some research previously where some of our younger generations are actually investing for the future. And one of the things that I found interesting is that, and I'm sure it's out there and one of you will be able to tell me, is where's the stress test analysis done if you talk about, even if you started combining things like, pay gaps. If I'm on, I don't know, a few $1,000s more than someone else, what does that actually mean 40 years from now, as opposed to what it means $3,000 or $5,000 right now? So what am I thinking about? Where am I missing out from an investment point of view?
Yeah, look, it's a very good point. And the other thing I'd throw into that is that wealth is a relative thing, not an absolute thing. So it's all very well me telling you you're going to have $10 million in 40 years' time.
Thank you.
But if everybody else has got $100 million, hard luck. So this is where it's contextualizing, well, what does that actually mean? And being able to provide people the tools to understand where they sit relatively to people their age, where they sit relatively to people in the same circumstance, where they understand what, if we're talking later goals, so retirement or something that's not on the foreseeable, what is the amount of money that's needed? And building people's comfort with the volatility along the way, because risk is broken down to two things. One, I won't get all my money back, and two, I won't get the money back when I want it back. So being able to differentiate between those two things. Look, what we've noticed, and it's about digital literacy or tech literacy, that we kind of write off older people. We kind of say, oh, granddad doesn't know how to use a computer. Well, a computer wasn't part of his life. And we all know that there is, even experiencing it ourselves a little bit, a bit of cognitive decline as we grow older. But if we're digital natives, and my first computer was when I was 8 years old, I don't expect that when I'm 80 that I'll have forgotten how to use a computer. So the death of checks, the rise of online banking, this sort of thing, we will be very accustomed to those sort of things. So it's kind of a silent generation problem, which the financial service industry is dealing with, where those who were born in the war do struggle because they just did not have technology is a big part of their lives. But we see a number of boomers, and we have a number of customers in their 70s who are very literate and very comfortable with using digital tools. So to just blame it on old people is kind of missing the point. This is not a millennial thing. This is a how familiar with technology am I? Because to me, 20 and 30-year-olds still think the same as 20 and 30-year-olds 20 years ago. They're just a bit more connected.
And I think it's interesting. I gave a presentation to a room full of 60, 70, and one of the questions I asked was, do you feel that you're actually technology savvy? And everybody said no. But I then said, how many have a smartphone? Everybody. And then I went through the whole process of how do you book in for your flight, order your coffee. And there was that realization, that dawn moment where I actually am quite technology savvy, more than I thought I actually was. And I think it's how it's introduced. If it's this big scary thing, then yeah, I think generally we tend to shy away from it.
It's also what you're familiar with now. I've got 3 kids, 16, 18, and 20. Technologically very literate. My son went to bake something in the oven the other day, and he used the bake setting instead of the fan setting, right? And he stuffs up his meringue. So, we talk about them being technical. It's what you're used to, and what you're familiar with, and what you're doing day to day. And I can't use half the functions on my microwave. So, I think these things. It's a relative, and what you feel comfortable with, and what you're happy with, and what you're used to doing on a day-to-day basis.
Yeah, absolutely. And I think as new things come out, one thing I'd probably say is just get in and dabble around with it. As long as obviously it's in an environment where you're fairly well protected, you're not giving away a lot of your data. And that brings me to a really interesting point. Data. There's so much of it out there. There's so much available to us. I think some organizations in the financial services world, however, have struggled a little bit to extract. And I don't know if this is maybe putting it in the right context, but maybe they've even struggled to some extent to commercialize that. And I don't necessarily mean commercialize that to make an extra dollar. Commercialize that to have a more deep and meaningful conversation with their customer, which then actually derives the correct outcome for said individual, as opposed to just off the shelf. There you go. Thanks very much. So just coming to you, Barry, and not necessarily just sticking with the sustainable or the ethical piece, but how are you seeing, or what would you like to see in the industry in terms of the usage of data to actually drive that blended conversation between the advisor and technology? That back to the point that Stephen was just making, that the individual actually understands.
Yeah. So I think often talking about the ethical and responsible investment point of view first, a barrier is often that many of the advisors went through their training and education without actually having familiarization with the ethical investment arguments. And things have moved on a lot. I mean, the research now shows that you get good returns from investing ethically, and the market doesn't price ethics and sustainability and climate change in an efficient way. So there's alpha to be made from investing ethically. And I think that kind of changes the picture for many advisors. And I think now we're seeing a wave of advisors starting to ask the ethical questions, starting to have those conversations with clients. But they're not always able to access the data and the financial information.
It's not even always there as well, is it?
Yeah. And we have yet to find the kind of the tools and the integrated way of using the data to make it kind of decision ready and advice ready. And I think that's something that is happening over time, but it's still difficult for people to know where to go and what to trust.
And whether that's meaningful. And whether it's meaningful information rather than just vilifying a company. There's a lot of oil companies, there's a lot of tobacco companies, there's a lot of casinos out there actually doing a really good job in terms of the harmonization or the path to sustainability.
Yeah.
And unfortunately, just with what I call brown funds, just exclusions. Oh, sorry, you can't be in our fund because you are in that industry. Well, those industries will still exist. So don't you want to be rewarding those who are doing better and penalizing those who are doing worse on a sustainability metric, rather than just being, black and white about it?
I think that's true, but there's also the customer perspective. So from the industry perspective, the industry doesn't like exclusions, and you know, we often find this whole sort of feeling that negative exclusions, negative screening is not a good way to be able to handle ethical and responsible issues. But if you look at it from the consumer's perspective, people say, I want to know what's in my portfolio. And by the way, I don't want to be investing in ExxonMobil and big bad oil companies. I don't want to be investing in coal companies.
But they do want to drive their car.
I don't want to. Yeah, sure. But there's a difference between driving your car and investing your money in these companies. And I think it's the same argument as alcohol. We get a lot of people coming to us and say, yes, I have occasional drink of wine or beer, or, you know, I drink alcohol, but I really don't want to put my money into alcohol because
they're not.
But there are companies
that they're not, and there's a lot of misunderstanding about primary versus secondary markets here. You're not giving your money to the tobacco company. You're not giving your money to the alcohol company. You're giving it to the previous shareholder. So there's a real misunderstanding that we do need to educate, and this could be, you know, through better tools, as you're saying, could be a really good way to be able to do that.
Yeah. So
Rita, you had a comment there? Sorry, Byron.
I was going to say, I think there's an education piece there, because you're talking about opening things up and that customers don't necessarily want to invest into oil, but if as you're saying, Stephen, you know, there's companies that are moving towards more sustainability in some of those areas, that again, if that deeper level of information is shared, then it's sort of an education piece and giving consumers that choice. Well, yeah, you know, I do still want to drive my car. These companies are going to be around. I'd prefer to invest in one that's going along this path rather than one that's blatantly ignoring it. And bringing it back to the wealth tech conversation, I think technology is sort of the perfect enabler to be able to bring this kind of education through and to help lift financial literacy generally across investors on a whole sort of different number of playing fields. Yeah.
George? I think that what we're trying to get to is a situation where people can feel confident in the decisions they're making with the knowledge that they are available to them to make those decisions well, and whether that should I be investing in equities or bonds or property or what mix, liquid assets, whether I should be going for sustainable, green, ESG. But there's lots of different things out there, and I don't think it's the industry's job to tell somebody this is what you should be doing. The industry's job is to help somebody go on a journey where they can make decisions that align with their values and what they're trying to achieve through their finances. That's the place that we're trying to get to, I think.
So maybe slightly controversial then. Do you think that if we look at someone that's invested previously and they're looking for the highest rate of return, but the information doesn't go down deep enough to really understand actually where the money's been invested? So I don't really care where it's invested, but my rate of return is really great, and that's what I'm really happy about. Fast forward into today's world, where actually now we can really dig much deeper into that, and we can actually have a look to oil, gas, wherever it may be. Have we seen a change in people's behaviour in terms of where they're investing, and is it significant in the industry at the moment, or do we think it's still to come?
It's really fascinating, because some of the big studies will tell you that there's a huge shift towards sustainable and RI, and yet interestingly what we see on the ground is much smaller moves. And I can't quite reconcile how these two things are happening, and I'm wondering if part of it is some of it's greenwashing, where a lot of funds, they'll say now 80% of the funds now do RI, but then you actually look behind it and nothing's really changed. The label's changed, or the boxes that people tick have changed, but actually what's going on isn't changed. And so there's this perception that all this money is moving into RI and green and ESG, but in reality it hasn't. So I think that's one element of it. And then I think there's also that shy Tory thing, which is that a lot of people will say something in public because they feel they should, or they have to, or they're worried about being deplatformed, or whatever it happens to be. And then when it comes to which fund am I investing in, I'm quite happy to take that fund, because that's okay with me, really. And so I think there's a difference between sometimes how people present or what they say, and then what they do in private. And some of it's just greenwashing as well.
Absolutely. But the other thing is that there actually has been a shift. And it has been significant. You're right, there's been a lot of greenwashing. But the shift has come from two things. One, it's come from consumers shifting, but it's also come from the industry itself shifting. And we've seen a massive increase in funds that are subject to serious ESG management, not just greenwash. And that is both engagement, but also shifting out of the worst funds. And we've seen $12 trillion out of the fossil fuel industry. We've seen fossil fuel sector index go down by 37% over the past 5 years. There has been a serious impact as a result of divestment. It's affected the cost of capital of the companies in those sectors. And there are these huge shifts going on. And I think it's important to kind of recognize this is a real thing that's happening, as well as the kind of marketing and hype behind it, because and the next shift is going to be into the very few funds that actually do good, the so-called impact investment funds. There are none yet on the New Zealand market at a retail level. There's some wholesale funds that have come close to it.
Watch this space. Give me a few weeks.
Cool. Yeah, lovely. Gentlemen, bring it on, because actually there's a real latent demand for people, for their discretionary funds, to be able to say, I want some of my money to go into things that do positive good in society, not just avoid harm.
Yeah. So, ladies and gentlemen, I think you can see we could definitely get the boxing gloves out here on this particular topic. But there's a couple of things just mentioned within it that I'd sort of like to just touch on as well. In the olden days, when I used to sort of work in the wealth division in some of the banks in the UK, wealth was perceived for the wealthy. And over the last few years here in New Zealand, there's been a number of organisations, as well as your own, Stephen, that have spun up. Do you think we're doing enough to actually go from wealth to what I would call sort of wealth inclusion or financial inclusion, making products that are accessible for everyone?
No, is the short answer. So, look, it's about the ability versus the competency. So yes, we have a whole lot more access to markets. We can create a portfolio for very low cost. But as we've seen with a number of Please Explains from the NZX, where be it a BGI, or be it a Canna South, or be it an Air New Zealand, or be it a Sky TV, where there is investors who really don't know what they're doing and who are actually just setting themselves up for failure. So it's great. Obviously, I'm part of the FinTech industry. It's great that we're using tools. We've got to be very careful that we are educated along the way, and that we're providing people the right tools and the right information. As a behavioral economist, one of my favorite sayings is information causes behavior. If you give people the wrong information, you will cause the wrong behavior. If you give people too much information, you will cause too much behavior. So it's very important that we get that right, and help through better advice and better education, people make better decisions.
And I think we really saw that through the COVID market fluctuations in KiwiSaver accounts. I mean, the sort of huge numbers of people switching from their growth down to conservative, just because they've got the ability now to do that in an online environment.
It's just a bank account.
So they've got that functionality, but on the backside, there's a real lack of the education there to help the investors through that journey, through that time in there, so in terms of the life cycle of that investment. So I think there needs to be a real upskilling in terms of the tools and the technology that is being used, especially within KiwiSaver, because that's that if we're sort of talking about making more people wealthy, at the base level, that's through KiwiSaver, right, at the initial level typically. And so I think there needs to be a really big onus through on some of these KiwiSaver providers to really look at what we can do to help our customers through situations like that, because they're seeing what's happening in the markets, they're panicking, but we need to be able to guide them and make them make better decisions.
The other one is one of my favorite books, which is called The Paradox of Choice by Barry. So, is more choice better choice? If you can have every choice in the world, does that mean that you will make the better decision? No, it doesn't mean that at all. It means actually you're going to get flummoxed, you're going to get overwhelmed, and you're going to make no decision. So you've got to give people the right amount of choice and not just give them a huge array. Walk into the supermarket, having never seen any of these products. If you've gone overseas into a foreign supermarket, how much longer does it take to shop in a foreign supermarket than it does in your own supermarket? You're just not familiar.
One of the biggest challenges that we had when designing GoalsGetter was how complex do you make it? And for people that are involved in the industry, as we are, our desire was to make it really, really complicated because it could do loads of cool stuff, because you can do loads of cool stuff. But for somebody coming straight into it, that's just overwhelming, exactly to your point. And I was watching my kids play a computer game, and you know how you sort of start off and it's really guided the first sort of few levels, and you can't make mistakes, and it only introduces 2 or 3 controls. And then as you develop in the game, by the time you get into level 12, 15, and 20, this thing's super complicated and there's stuff flying all over the screen. I was thinking, how do we create a tool where people can come in at a basic level and do what they need to do, but it allows you to build and grow as you get more confident and more sophisticated and you want to take the tool deeper? We're not there yet, but I think that's what we're trying to achieve, so that people can use tools to the level of their own sort of confidence, ability, and desire.
Yeah, but you asked a question, James, about financial inclusion, and I worry. I talk a lot to the Commission for Financial Capability, and they've got the stats around, 24% of people are basically largely excluded from the financial system, and 40% are sitting there quite insecure in terms of their financial management. If I look at the 24%, a lot of them aren't in KiwiSaver. KiwiSaver was not designed for them. And I worry about that, because our major product that we have in order to encourage savings and include the participation of people so that they will have savings to go into retirement is not working for 24% of the population. Yeah. I really, it concerns me, and I think there is some new thinking, as was shown in yesterday's session, which I thought was really useful, and Susan St. John and others were talking about how you redesign elements of KiwiSaver to make it more inclusive for those people who would otherwise miss out. Yeah. And I think that's a really important perspective, but also, in addition to that, there's a broader kind of aspect of financial inclusion, and I'm part of something called the Sustainable Finance Forum, and it's a finance sector, business, government, others, cross-sectoral initiative to try and map out a roadmap towards sustainable finance. And financial inclusion is one of the key issues. You can't have sustainable finance if it doesn't include everyone. And there's been some fascinating discussions in that around how we make some of the changes to financial products in the financial system so that we can make finance serve better the people who aren't likely to generate a whole lot of profit for the industry players. And I think that's the fundamental dilemma. If you can't make money out of people, how do you include them, and how do you help them with financial products?
That's the advice gap. And so at its core around KiwiSaver, it's a marshmallow experiment. It's delayed gratification. I will take the dollar today rather than put the dollar into my KiwiSaver because I need the dollar today. Yeah. Future me, they can deal with themselves. I need the dollar now. So, whether KiwiSaver becomes compulsory, the argument goes round and round, or whether you have to be able to get out of it in reasonable circumstances, everybody needs to be in KiwiSaver is the short story. Beyond that, it's the advice gap, and which is what we're all trying to help with, because with new regulation, with FSLA coming in, the advice gap, I think, is going to get bigger for a while, because I've already heard from financial advisors having to raise their minimums because they don't want to deal with customers at a certain level. So that's where we need to make sure there are options available so that people can get the advice, can build their financial literacy, because it's going to the dentist. I thought that was one of the best comments, yesterday from Jane Wrightson. You know what? Financial advice is going to the dentist. So we can continue the analogy and say, well, you only go when it's an emergency, and only the wealthy can afford to get their teeth whitened. But we need to make sure that we can get more access to the dentist, and that going to the dentist is a better experience.
Because we put off doing things that we don't like, don't we, right?
Who likes doing it?
And who likes it? And for most people, and maybe we're in the room, or maybe I'm a bit of an exception, enjoys thinking about and looking at your finances and planning and spreadsheets and numbers and stuff. That's my world, my background as an actuary. But for most people, that's not their experience of thinking about finance. You say to somebody, do you want to think about retirement? How much money do you need in retirement? How much do you need to save now to get into retirement? How long are you going to live in retirement? And what's your financial plan? what you've just lost most people at that point. How do you make that whole journey experience somebody thinks down and says, this is helpful and useful, and I'm going to put some time aside, and maybe I can sit down at home with my glass of wine, put my computer on, go through some few bits, work out something basic, feel good about it, and then I just want to park it, which is probably the right thing for most people to do. Park it for 5 years and come back and have another look again then.
Yeah. Good discussion. So there was a couple of little things in there that were mentioned. We've talked obviously a little bit around financial inclusion. The other thing that we talked about just there was regulation. Now, we operate in one of the most heavily regulated industries in the world, and some of the regulation that was on the runway has been, let's say, shifted out a little bit, but the reality is obviously it's still there. So there's a couple of elements to this, and it might be putting you all on the spot. Do you think that we've got the right regulatory environment here in New Zealand that breeds the situation where we can tackle financial inclusion, we can tackle financial literacy, create more products, but not too many, Stephen, because we don't want to bamboozle, but equally, actually, that it really does drive innovation and actually just makes it, to George's point, easier for everybody. I'll pick on George, if I may.
There's 2 or 3 areas that we can go here. So one is that I think by global standards, New Zealand is not particularly heavily regulated in this area, and regulation has a very important role to play in the industry. Regulation is often about helping, it should be about helping the whole industry, but really it's trying to protect the most vulnerable in a situation, which is helpful. And sometimes there's some collateral damage further on. So one of the downsides of elements of regulation and fees is it does at the margins prevent innovation, more sophisticated products, more differentiated type offerings. It's very hard to see them entering KiwiSaver given the focus on fees and some of those aspects. And so it drives those into private equity, venture capital, and then you get the comment, oh, well, only the rich and those in the know can do it. Well, that's because they're the only ones that, because it's been covered off by regulation, it prevents or it's difficult for it to get in. That's one area. The second is that the regulation has all been drafted thinking about human advisors and human advice. GoalsGetter was the first digital advice tool on the market, and that was launched after the recent regulation. So the regulators have never operated or worked in an environment where they've seen these tools live in the market. And it's not that the regulation isn't fit for purpose, it's just that the market is moving quickly, technology is being developed, and regulating a person who's got all sorts of biases and behavioral issues and the way that they operate that you want to regulate and manage. A computer doesn't have behavioral issues to deal with, it's got different issues to deal with, and it needs to be regulated differently. And the harm that a computer can do is quite different to a harm that a person would do. So talking about a framework that says you must act with integrity, a computer doesn't act with integrity or disintegrity, a computer just does what it's programmed to do. And so I think the way that we regulate FinTech and robo-advice has to be different to the way that we think about regulating human advisors.
Yeah. But I think if you do bring it back to some of those broad level principles that the people, because obviously there's people behind the development, there's people that are sort of programming and building the algorithms and that kind of thing. So I think at a broad level initially, it will be interesting to see how it pans out, that's for sure. But I think at a broad level, in terms of sort of applying the same principle and conduct requirements to the people that are actually doing the inputs towards those things, is probably a good starting place.
Yeah, I mean, I'd add to that I like that we've got a conduct regulator, that it's, that is principles based rather than prescriptive. Where, as George says, there's a number of aspects of industry that are actually unregulated or lightly regulated, and that's actually an issue. It's more about that the regulator is able to keep pace with the tech development and actually, rather than reacting to the bad outcomes, can actually start to set best practice. Can start to help laggards get to where they need to be, rather than using the stick where it's we're naming and shaming you, or we're doing that. So look, the challenge with our industry overall, which I think was the question, is that in New Zealand we're based on inside charges. So we've got an industry of mortgage advisors and of insurance advisors who get paid on the inside, so that customers don't actually value the advice. They don't actually see the cost. And as a result, the incentives are misaligned. So we can bring up fiduciary duty, we can bring up good customer outcomes, but if my incentive is to get the biggest commission, then am I really going to have the customer's outcomes as predominant? As long as we've got trails and commissions in place, rather than being transparent about, actually not just I get paid by the product provider, how much I get paid by the product provider, or saying, no, you cannot, there needs to be a benchmark around this is what you can get charged as a distribution fee, or this is what you can get charged as a commission, this is what the value chain looks like, not just, allowing crazy things like payment for order flow to come to New Zealand. We're in trouble if that happens. Robin Hood, anyone, where's the well-being there?
I also agree that it's good to have a conduct regulator, and the trust issues were kind of very evident in the Hain Commission, but also over here as well, and we shouldn't deny that. But I'm also doing my level 5 qualifications belatedly, and I'm very well aware of the burden of compliance for advisors, and it is an issue to get the balance right. I think overall, the balance is good, but it tends to be patchwork. If I look at the Robin Hood and the Sharesies, lots of young people going out willy-nilly buying shares with, I think, often quite inadequate information. It's a very lightly regulated part of the market. If I look at crowdfunding, for example, the most risky funding you can have, startups at a really early stage, and it's very lightly regulated. However, if you look at the regulation around issuers, then of larger amounts, which are often part of angel collectives or part of broader regulation, there are mechanisms in place. So I think there are patchworks. It's around often solving the last problem we came across rather than the next problem. And I think without wanting to have a whole lot more regulation, there are some areas where I think some regulatory action is needed, and certainly on the issue of responsible investment, definitely some is. And the FMA started an inquiry on misleading claims around ethical and sustainable, and we've yet to see the results of that.
Meridian's advertisement being pulled, that's a classic example. Indeed. Sorry, your electricity, when you switch it on, there's a little bit of coal in there. There's a little bit, but every time you switch on a light switch, regardless of who your provider is, you've got some coal.
Taken from the pool.
Yeah.
So we've got about 7-ish minutes to go, and we've got a couple of questions come in from the audience. Thank you very much for that. Sticking with the theme then, how do you think the regulator cite good practice? And for MIS providers that also offer digital advice, should the advisor play a role? Rachel.
Well, I think I'm not entirely across sort of the various regulations for MIS providers, but I think it is a tricky field, because I think there is a lot of sort of fund managers out there that are looking to bring through these kind of tools, and you would think therefore that there's got to be some sort of regulation, I would think, around the management of those digital advice tools and those kind of tools. So I think there's got to be something there, because otherwise, as I said, I'm not totally across the MIS rules in terms of whether or not that would be covered, but I think there would have to be something governing the provision of digital advice by MIS providers.
Yes, so under our MIS license, obviously we're required to have a supervisor to offer the products. The advice behind it is separate and outside of that. Should that come under the same supervisor? Probably not, because I think that it needs to be there, but it's probably not part of the supervisor's role. I think it falls within the advice component, and therefore it should sit with similar to advisors, the human, but probably I would like to see the regulation evolve so that the regulation for FinTech and digital advice is separate to but associated with that whole advice piece, rather than the provision of funds and products, which I think is a separate element to the advice that goes in behind it.
And just maybe the last question, actually, we'll try and finish on a bit of a positive. What do you see, or what would you like to see aspirationally from an advice perspective in the next 3 to 5 years in New Zealand? Barry, if I can come to you.
So I think the whole direction of the FSLA regulations is kind of basically the right direction. I sort of really want to see the customer perspective take primacy, and We would have liked to have seen in there a requirement that advisors ask the ethical question. And I think it would be good to build that into supportive codes to ensure that happens, because it's now become something where there is a lot of evidence that people do care about these things, and asking the question about, what kind of standards do you want to apply to your investment, I think is part of getting to know your customer and good customer relations. So that's something we'd like to see. On the standard side, there's a whole lot of stuff we would like to see around clearer standards around the definition of terms for ethical and responsible, and in future impact investing. Because at the moment we've got very, very clear rules around the measurement of your fees or the measurement of your returns, but we've got no parameters around calling yourself ethical or calling yourself responsible or saying you do ESG management. What do you mean? What are the standards? And how could customers or advisors compare across funds? And I think that's absolutely crucial to apply to build more trust into the responsible investment space.
Just before I come to the other speakers, you mentioned there clearer standards. Is that for the regulator, the supervisors, or do you see that a blend of industry and the regulators working together to create them?
Ideally, it would be industry self-regulation, but that hasn't happened. Aside from some certification scheme by, for example, Responsible Investment Association, but that's not widespread amongst providers, and so I think in the absence of self-regulation from the sector, the regulator probably has to take a leadership role working with the sector, but I think some leadership is required on that.
Okay. George, if I can come to you for that same question.
I think the way that advice would be helpful is just to see the barriers continue to come down, so that more people are able to access the advice that they need, which doesn't necessarily mean that everybody has to have a full suite of full financial services planning and advice, but to the degree to which some advice would be helpful for you, can you access that easily and simply and without barriers at an appropriate cost for what you need? And I think that FinTech is an essential part of that journey.
Mm.
Stephen?
So one of my favorite analogies is cutting your finger. And if it starts to bleed, well, at home you can find a Band-Aid and you can figure out how to fix it. And there comes a point when you've cut yourself deep enough or it's bleeding enough that you'll go see a doctor. And then there comes a point where if it's still bleeding, if you've really chopped your finger off, you need to go to hospital and see a surgeon. And at the moment, our industry is built around surgeons. Anybody who needs any help has to go see a surgeon. You need to, the full financial advice, you need to pay somebody, either a significant amount of money or know that they're making a significant amount of money, because to onboard you, to look after you is quite an operation, and there's quite a cost behind that. Not to mention the onboarding and the cost of client acquisition, which a lot spend their time doing. So in terms of 3 to 5 years in the future, my aspiration for advice is that we start to get things in the middle. We start to be able to have, those start to fill that advice gap, and that it starts from a point of education, that you can't just give people access to a full suite of products immediately, that you can actually support people through good financial decisions, good financial literacy, to the point where it is when they do need a surgeon that they're seeking a surgeon, rather than that's the only thing available. Yeah, I think if we can start to fill that gap, it will take time to develop the products. Nobody likes seeing the dentist, to mix my analogies, but that will be useful to allow greater access to advice, and that's more likely to be in the hybrid format where the cost to serve is lower.
Thank you. And Rachel, just with a couple of minutes to go, your views.
Yeah, sure. So there is a lot, I think, going on at the moment behind the scenes as sort of companies are getting ready to bring offerings through to market. What I'm really hoping is that when the new regulation kicks in, that it's actually, that it's sort of the right at the right place to be able to allow all of these things to come through and actually offer the value that they need to offer and do the things that they need to do. I really hope that we don't see the new regulation come through and actually end up stifling some of this innovation. I really hope that it comes through and it's moving in the right direction so that companies can continue to bring through new offerings that will fill that middle section, as you're saying, Stephen, so that middle section and the lower section who are missing out on the advice can actually get it and that it's good quality. The other core thing for me is that KiwiSaver providers bring in a whole lot more initiatives to actually support people so that if we go through more market events like COVID, we're not seeing the bad decision making there. There's a whole more learning and tools online to support people through that process.
So ladies and gentlemen, that concludes our session today. Hope you've taken away some of the key insights that the panel were able to share. Lots for me, I've been making notes as you probably have seen, but two that really stand out. Get a good dental plan and be very careful with knives, as long as a lot of other things. But yeah, thank you very much for joining us on the FSC 2020 Generations Conference for our session today, Sweeping Changes, the role of tech in shaping the wealth of the next generations. I'd love to thank our panel for taking the time and getting up early, catching ferries and dealing with Upton traffic. Rachel, Barry, Stephen and George. And a supplementary thank you to George for hosting us this morning. It's been a great session. I've really enjoyed it. I've been James Brown, General Manager for FinTech New Zealand. Thanks very much and enjoy the rest of the conference. Thank you.
Thank you. What a fabulous range of discussion we have had this morning. A special thanks to Bravura for their kind support of the FinTech session. It's so interesting to hear from the panel about how FinTechs view the next generation of investors and how the advances in technology is helping engage this group. And on the topic of generations, hearing the shared wisdom from the panel about their own leadership journeys gave some fantastic advice for the young leaders amongst us. And finally, the insurance session had wonderful insight from an all-star cast into income protection ideas, innovative ideas on helping Kiwis getting back to work. Before we launch into the main platform, where we hear from a mixture of politicians, journalists, and our keynote speaker, Jace Tapatu, please take this opportunity to have a 10-minute break, have a stretch, and enjoy some of the fresh spring air. See you in 10. Hei konei rā.